Hello, good afternoon, everyone. I appreciate the time you take from your busy weekend to attend my presentation today. Maybe some of you have attended my presentations in the past, some haven't. So let me introduce myself. I'm the designated fund manager for several of the conventional funds in KAF Investment Funds. One of the funds that was recommended by Fund Supermart, the KAF Vision Fund, which focuses on small mid caps. So today I'll explain to you the areas where I see opportunities and how I plan to navigate the challenges that we see today. Okay, so in this first chart, we can see the performance of the FBM KLCI against the FBM small cap index since the end of 2013. As you can see right here, since the end of 2013, which is about 9 years, the FBM KLCI have been down 26% versus 5% for FBM small caps. So this is something that we have explained to our investors in the past, that we constantly emphasize on stock picking. This is one of our strategies and one of the philosophies of our company. Because we think that as a country, if you were to invest in the KLCI ETF, this is something commonly explained or actually highlighted by, investment gurus like Warren Buffett, where they keep telling people, buy ETFs, you outperform mutual funds, because it's cheaper, you save on management fees. That may be true in the US, where most mutual funds actually underperform the ETFs on average. But in Malaysia, that's not the case. If you were to buy the KLCI ETF, you'll be losing money like close to every year. So if you look at last 2 years itself, it's have been a very challenging year. So we strongly believe that, if active fund managers in Malaysia, still can generate value for its investors. And if you look at this chart, you can see that small caps do outperform the large caps in Malaysia. The reason so is, there are a couple of reasons actually. The first reason is, why large caps in Malaysia have been underperforming. I think most people, have been talking about it, have been puzzled. Why the CI is so weak, year in, year out? Because this is not something new, this is something that has been happening for the last decade. Why the Malaysian market have been so challenging for everyone. Now, I truly believe it's because, you see, in our Malaysian market, 40% of the components in the KLCI index is banks. So banks, the performance will be very reflective of the whole economy. So if your GDP is growing at 4 to 5% a year, you can expect that your CI stocks, the earnings will grow at 4 to 5%. But, we have to take note of one thing. You see, in Malaysia, the top 30 largest company, they get, if a company becomes bigger and bigger, they get included into the KLCI index. Last few years, we see the companies that are included in KLCI index, it's not because the earnings grew 30, 50% a year. What we saw was PE expansion. Companies trading at 30, 40 times PE. So when your companies who are trading at 30, 40 times PE got included into the KLCI index, over the years, in the next 1 or 2 years, more likely than not, they will disappoint than beat expectations of investors. Because when you're paying 30, 40 times PE for a company, you have very high expectations of its earnings growth. So, time and time again, we human beings, we have a tendency to extrapolate. So, again, they got included into KLCI, then after that, earnings disappoint, then, the stock price starts coming down, and then they got sold off, and then they got excluded from the KLCI, and then another new company, that's now trading at 30, 40 times PE got included in the KLCI. So you see, because of that, by nature, it's very difficult for the KLCI index to do very well. And then, of course, the 40% is your banks, and then your tenaga, which is, it's going to be very stable. It's going to be reflective of the whole economy. I think last 10 years, Maybank's returns are about, total return is about 4 to 5%. So, that's something you can expect. But then, of course, because of the new inclusions that, have a high tendency of disappointing investors, so when you net it out, your earnings are relatively weak. But nevertheless, if you look at this chart, which is something that I've constantly shown in my presentations, these are the regional equity performance of our ASEAN neighbors, not against US, okay, not against our European peers or Asia-Pac peers. This is against our ASEAN neighbors in US dollar terms. And if you can see, which index is at the last? Us, of course. So if you're a foreign investor and you were to invest, in US dollars, okay, in our markets since the end of 2013, after 9 years, what you'll be left with? Half your money. Half your money. Let's not compare with, your likes of NASDAQ or even comparing with our regional neighbors, the likes of Indonesia, the likes of Philippines. We are far behind. Look at the disparity there. So, which is the reason why I do believe that, we are a laggard market, but, time and time again, we have to be patient. Because I do think that one day it could be our turn. But why like that? Now, if you look at the performance of various asset classes, I think lately the main talk of the town is recession. You ask people, what stock you're interested in, what stock is good to buy, what is good to invest in. Most commonly, you get, the common response that everyone gives you is, hey, you crazy, you want to buy stock now? Recession is coming, hold cash better, which is my title, why I think the future belongs to the optimists. It's very difficult to time markets. We never, ever actually suggest or recommend our investors or prospective clients to try to time, the entry into the markets. I don't think anyone could do it accurately. Anyone who tell you they can, I think they are lying or delusional. But no one can. Okay. So if you look at it, since this chart shows that the performance of the various asset class since the start of COVID. So okay. The market did well. I think most of you, in this room actually saw how well the market did in 2020, right? 2020, even though, from a financial market standpoint, it's a great year, but, as a whole, in the real economy, it's not so good, because of the pandemic. But nevertheless, a lot of people made money in 2020. And then what happened? 2021 is a bad year for Malaysia. 2022, a bad year. What it's looking like right now is 2023 is going to be another bad year. 3 consecutively bad years. So sometimes I so feel bad. People start to ask me, why Malaysian market like that? I also say, I also don't know why people don't want to buy Malaysian market, right? Every year lose money. So if you look at this chart, right, the MSCI ASEAN index, okay, is actually trading at 20% below its pre-COVID levels. And if you look at the rest of the world, like MSCI Asia Pac, also slightly below pre-COVID levels. So that rally we've seen, all the returns have been given back already. The only place that was still very strong is the MSCI World. Why? Because the largest component is US stocks. Okay, this year, NASDAQ is up 30%, S&P is up 15%, the Philadelphia Semiconductor Index is up 40%. So what we can gather here is this. If you look at the S&P index and you strip off, your AI-related stocks, your large tech stocks, then performance of the S&P 500 is actually quite lackluster one. So essentially, the strong performance that we have seen is because, strong push in technology counters. But again, in Malaysia, tech stocks, different story. But I'll show another chart later. Now, what can drive the performance of the KLCI index? So it being by default large caps, historically in the past, people keep saying that Malaysian stock market should trade at a premium one to our regional neighbors. Why? Because we got large institutional funds in Malaysia. So it's a captive market. So in a captive market, we always trade premium valuation because this money has to stay here. Your likes of your EPF, your co-op, they will always reinvest in Malaysia. So, but that's no longer the case. As it stands right now, KLCI is trading at 13 times PE forward PE, compared to its historical of 17 times PE. So we're no longer actually trading at a premium anymore. We're trading very close to our regional peers. I think Singapore is about 10 times PE, whereas the likes of your Indonesia, your likes of Philippines are trading at a significantly higher valuation. So we are no longer trading at a big premium to our regional neighbors already. And what can drive the Malaysian stock market higher, or at least the KLCI index? Foreign inflows. That's the only thing we can bang on. But as it stands right now, if you look at last 5 months, up to May, Every single month, foreigners are selling Malaysia. Last year, good year, foreign inflows was 1 billion US dollars. After 4 consecutive foreign outflows. This year, actually, if up to last Friday, the foreign outflow in Malaysian equities is about 4 billion. In last month itself, we saw 1.3, 1.4 billion of foreign outflows. So, for the KLCI to do well, you need foreigners to come in. Because our locals are not going to plow more money in. If they're in, they're already in. It doesn't seem like they're going to put more money in. So, from a large caps perspective, the big push will have to come from foreigners. So what can drive foreigners to come in? If you ask me, people can tell you all kind of things, but my honest opinion is all about a story. It's about stock price action. It's about how, FOMO, people keep telling you fear of missing out. You see the narratives of, different regional markets, right? There's always 2 sides of the story. If you look at how journalists write papers, right? An event can happen, and if the stock price goes up, they can explain it. Stock price come down, they can explain it on the same event. So basically, what will drive foreigners in is we need our market to actually start to be more vibrant. Last few years, you are slowly seeing the value traded coming down. I think this year, the average value traded a day is about 1.9 billion. Last few months, about 1.4 billion. During its 2020 height, right, the average value traded was what? It went all the way up to 4-5 billion. So what's that telling you? Investors are not putting money in the market. Local investors are not putting money in the market. Fund managers are not putting money in the market. And I can honestly tell you, when I speak to my peers, a lot of them, they are fearful. They are worried that the recession is coming. Now, I still think that there's a lot of money in this market right now. It's flush with liquidity. If you look at this chart right here, the US money market mutual fund total assets have actually been going up. It's standing at 5.5 trillion, even though US Feds have increased interest rates on the 10 times, 10 consecutive meetings. And why is it still, still at elevated levels? If you look at the chart on the right, US pandemic savings, right, is still significantly higher than where it was. Because, during the COVID period, the US government was just handing out free money to everyone. So this money, imagine this, as a US consumer, when you get the money from the government, you start spending it. The money just doesn't disappear. It actually moves around. So the multiplier effect of money have been flowing around the markets. So that's why I still think that there's abundance of liquidity in the markets. If you look at this one, okay, it's an asset allocation survey in the US. What we can see is the cash allocation is still at a relatively stable rate. It is at its normalized level at about 20-odd%. So, just now we saw money market mutual fund assets are at 5.5 trillion US dollars, at elevated levels. But actually, you look at it from an asset allocation standpoint, it's not like, they have started to hold 40-50% cash. So, there's just a lot of money in the market right now. It's not like, they are holding very little cash or so. So I personally feel that, there is opportunities, and where are the opportunities? So one area that we like right now is Malaysian tech stocks. Okay, it's a sector that everyone now is trying to stay away from. US Philadelphia Semiconductor Index, the SOX index, since the end of 2020, as you can see, it's up 30%. This year, it's up 40%. Malaysia KL Tech Index, since the end of 2020, it's down about 12-13%. Whereas this year, we are down about 3%. So the disparity in the performance of the US tech stocks and Malaysian tech stocks have widened by a significant amount. And if you look at previously, there's a strong correlation between Malaysian tech stock and the Philadelphia Semiconductor Index. But, now what we're seeing jaws here. The disparity have widened. So I truly believe that there is opportunity for the disparity to narrow. I do think that, you know, the fear now everyone have when I speak to people is why they're not buying Malaysian tech stocks is mainly because earnings are going to be weak. A lot of people are telling me that, you know, look, consensus expectations are still too high, you know, there are more room to downgrade, which I agree. The thing with Malaysia is our sell-side analysts actually is a bit slow to downgrade the earnings. It's not because they don't know the earnings are coming down. It's mainly they don't want to offend the management of the companies that they cover. You know, because, you know, you downgrade earnings of the company, then the boss come and tell you, hey, you like that next time, I don't want to tell you things anymore. So they know actually that the earnings was coming down. Actually, a lot of fund managers also actually know that earnings are coming down. So, but then on paper, on what people see, okay, they have yet to do the downgrades yet. But in US, it's very reflective, okay? People do downgrade very quickly. And I do think that we are at the trough right now. I do think that in the second half, you know, we are going to start to see, you know, earnings picking up from a lower level. So essentially, when you invest in technology stocks, you're investing in the future. And the second driver is the weak ringgit. So again, exporters should do well. Ringgit is at what, 4.67 today, right? To the US dollars. The weak ringgit should drive the earnings of the exporters, something that we see in Japan earlier, I think. So I do believe that, you know, Malaysia by default, of course, you know, do we have the likes of NVIDIA here? No, we don't, you know. It's, again, very cyclical. But then, we do think that they will benefit simply because it's just cheaper to do it here, and the US and China tensions. So right now, because of the US and China tensions, you know, tech companies are actually moving out facilities, you know, to other places. And Malaysia being such a small country, all we need is just to take a small chunk, you know, from the Chinese companies. That will do. So it's simply, you know, we are just benefiting from the trade reallocations. So that's why we are investing in a few companies that we think would benefit from this, where they are, you know, transferring the production from China to Malaysia. And if you look at it, obviously, yes, there are the larger tech companies who are reporting weaker profits, but there are also some smaller ones that are still actually delivering the earnings that everyone is expecting. They are actually still growing. So, you know, as a stock picker, these are a few things that we look at. And then another area or sector that we actually like is energy. You know, it's a sector that is, you know, now everyone keep talking about ESG. Everyone say that, oh, crude oil is bad. You know, if you really think about it, we are actually, crude oil, yes, you know, it's dirty, but natural gas is not. Natural gas is one of the cleanest form of energy. And this is actually one area we like. And actually for Malaysians, we cannot really hate energy. You know, we really depend on Petronas, you know. So even though people say energy is bad, we say, no, we disagree. By default, you know, if you look at Malaysian energy sector, this year, Malaysian energy sector is up only about 2 percentage points. But why I like this sector? Several reasons to it. First, the monsoon is over. Okay? I'm not going to tell you that these are companies that I invest in, these oil companies that I invest in, you know, it's going to have multi-year earnings growth. No. What I'm seeing right now is monsoon is over, the next few quarters should be strong for Malaysian energy companies. And if you follow Bursa announcements lately, you are starting to see that there are a lot more contract awards for these oil and gas services companies in Malaysia. Petronas have indicated in their Petronas Outlook report where they're going to increase these capex from about 40 over billion a year to about 60 billion now for the next 5 years a year. Now you look at it from domestic standpoint, okay, if you strip out the offshore one, okay, look at only from a domestic standpoint, we're looking at about 22 odd billion a year, which is about, not that much, but, you know, still about 6% growth from its previous years. So this is one of the areas where we are still actually seeing earnings growth, the energy sector. And if you really sit down, it's not too difficult. Look at all the other sectors, okay? Property sector, is the earnings growing? No. Construction, is the earnings growing? No. You know, plantation, Is the earnings growing from last year? No. So if you really break it down and look at all these sectors in Malaysia, most sectors in Malaysia are actually showing earnings contraction. Whereas energy is one of the areas that actually will deliver earnings growth this year. So this is not a stock. You know, people tell me 20 to 50, no more already, oil and gas, you know. Yeah, that's 2050. Today is 2023. I don't intend to invest in these companies and hold for 25 years, right? So for us, we're active fund managers. Maybe 6 months down the road, you come and talk to me, I may no longer have any energy stocks in my portfolio anymore. But at this juncture, I like it. Because I think earnings will come in, I think there will be contract awards, and I think that this is one area that, you know, investors have shunned. Because how do you determine whether investors have shunned this sector? Valuation. There are several companies that were invested in, trading at single-digit PE. You know, in Malaysia, single-digit PE. I think if any of you were to invest in Malaysian equity markets, I think you all agree with me. This is one sector that no one really looks at it anymore. The sector that people have been, talking about a lot was always the tech sector because of the strong earnings growth. But we think that, the valuation here is very attractive. And if next 2 quarters you're going to see strong earnings, I think my downside risk is relatively low. But I'm not going to tell you I guarantee we'll make money. No such thing in this market, okay? So essentially, I look at it when I were to make any investment, whether it's small cap, large caps, we always look at what is our potential downside. Is it worthwhile for us to make such an investment? Oh yeah. So yeah, I also wanted to mention. So another thing is the Saudis, right, need the oil prices to stay strong. Now, if you look at this, where it stands right now at $70 odd, I think it's highly unlikely for oil prices to drop further. They recently just mentioned that they're going to extend the 1 million barrel cuts a day. And I think that why they need to do well, because, if you're spending so much money, on other economic developments and on your football clubs. I think if you all monitor football clubs, actually sports itself, they spend so much money on live golf, buying up golfers, paying them ridiculous amount of money. They're now paying footballers ridiculous amount of money because they want to, they know they cannot be so dependent on oil forever. So, but then to fund all these expenditures, that probably will not return anything to them in the near term, they will need oil prices to stay strong. And being one of the largest oil producers, I think they will make whatever it takes, do whatever it takes to actually keep prices strong. So I think from an oil price standpoint, the downside risk is also relatively low. Now, this is also one of the reasons why valuations have expanded so much over the years. When the Fed was printing money and just handing out cash to everyone, right? But then that's changing right now. We have been talking about QE in the past. Now it's all about QT. The Fed is tightening. The US economy is, they're trying their best, to suppress the US economy. But why is that not translating to slower growth right now? You see interest rate gone up so much to what? Now 5 to 5.25%, the Fed funds rate. And based on the recent job report, it seems like it's going to go up another 25 basis points in the upcoming meeting. People are expecting after that another 25 basis points. So why at interest rate at such high levels, the US economy is not still slowing down yet? It's because when interest rates were extremely low, a lot of Americans actually refinance and start to went into fixed interest payments. So they lock in their low interest rate. Because think about it, when interest rate was at 0%, logically you would refinance your house and try to lock in at the lowest possible rate, right? Because it cannot go lower than 0%. Hence why it's not translating to higher mortgage payments yet. If interest rate gone up to 6-7%, I tell you, the economy gone. How many people can actually afford to pay their car loans, house loans? But because in US, they actually refinance it. That's why it's not trickling down to the economy yet. And number 2, the wage growth is still extremely strong. Why? Because over the years, the segment that didn't do well was the likes of the B40. And what the likes of B40 do, the services industry. And what we're seeing in the last few years is when, COVID went away and, the whole market start to reopen, people need to hire, restaurant workers, people working in the hotels. So it is this segment, the services sector, that is seeing strong wage growth right now. And which explains why, it will take some time. But when your interest rate goes so quickly, it will eventually hit them. So I do believe that eventually the US Feds will have to stop increasing interest rate. And that could be one of the catalysts for the Malaysian tech sector. So somehow Malaysian investors, we would always like to see the thing come through first and not anticipate. So maybe that could be one of the catalysts when US actually stop increasing interest rate. Because in the last few years, people have, been trading tech stocks as like to bet against interest rate increases. So as the opposite were to happen, we do anticipate that, Malaysian tech stocks may start to do better. That's one of the catalysts that we think. And then furthermore, if you look at the 10-year rate of US 10 years at about 4% compared to the Fed fund rate of 5%. So what does that tell you? Actually, basically the market is telling you that eventually these high rates are not sustainable. They will have to eventually cut rates, which is a view that we have too. Now, this is one of the funds that I manage, KAF Tactical Fund. And this is the performance of KAF Vision Fund, one of the funds recommended by Fund Supermart. We focus predominantly on small and mid caps. If you look at the performance of the fund, it's up 122% since the end of December 2018. Compared to 34% of the FPM small caps. So you see, you cannot buy the small cap ETF, right? There's no small cap ETF in Malaysia. And if you want to have a proxy or you want to invest in Malaysian small caps, you either have to do it yourself and start, stop picking one by one. But because it by default is being small caps, usually elect analyst coverage. So if you want to buy a basket of small caps, the only way to do it is to actually invest in a small cap mutual fund. And that's something we offer. And we have shown time and time again, we have proven that we can outperform the markets. And we have done well actually in the last few years. I mean, if you look at our performance speaks for itself. So we think that there are still a lot of opportunities in the small cap space. And if you really think about it, because by default, small caps is small. You're talking companies like what, 200-300 million market cap, right? Compared to something that's 6-7 billion. A small event, an event that can be independent to the company itself, can actually benefit the company. But for the likes of Maybank, there's unlikely there's any independent event that can actually change Maybank's profitably by a large amount. Whereas a small caps, all they have to do is win one contract, from a US supplier, and you can see earnings quadruple. These are things that can happen in the small cap space. But nevertheless, there's also a lot of risk investing in small caps. That's why, every day, us as fund managers, what we do is we constantly look for opportunities. We scour through all the quarterly announcements, try to go meet management, try to understand what's happening. And then we have a better picture. Okay, what is doing well and what's not doing well. Then we start to see. Sometimes we drive all the way to Penang or the outskirts. Like Kedah, to see companies, to understand what they're doing. So that's what we're doing. That's what we have been doing, and it has been translating to our outperformance in the past few years. So I think I would like to conclude my presentation today. I think later we have the one more session, right, to discuss. I think if anyone have any questions, you all can start to post there. Thank you very much.